Hey, it's Ryan from the Dividend Investors Club, and this is our market trend tracker for the weekend of January 12th, 2018. This is something new we're doing. We're going to start doing this on a weekly basis, but it's something to help you understand the trend of the general market, which I think is absolutely critical for long-term investing success. Obviously, you want to invest when the market's trending higher, and obviously be a little bit more cautious when the market's trending lower. And make your investments accordingly. And this is something that's just going to help you quickly see kind of what the trends are doing, making sure they're still intact, understanding the underpinnings and rotations that are driving that trend, and obviously help you just make better decisions as you're building your portfolio, managing your portfolio. So here's kind of the first page, and just kind of explain, how this is working. So we've got the S&P 500 over here on the left-hand side. I've got a graph here that looks at the Treasury yield versus dividend yield. Obviously, as dividend investors, interest rates obviously have an effect on the attractiveness, if you will, of higher yielding dividend stocks, and then obviously the volatility goes into account of, it could be a number of things, complacency, but certainly something to track if you're utilizing options, like we obviously do in our triple income portfolio of, cash secured puts and covered calls and things like that. That's one metric that we obviously follow closely. And then obviously to the right here, we've got some performance analysis for, some sector ETFs. We've got all the main sectors in the S&P 500 there, as well as some other kind of subsectors that we like to follow. And then on the bottom, we've got, asset class ETF performance, which obviously helps us, look at things like value versus growth, emerging markets, small cap versus large cap, real estate, commodities, things like that are moving that, may have an effect on kind of the overall trend and just healthiness of that trend. And so, I'm going to try to keep these to under 10 minutes. This one may be a little bit longer as I'm just kind of explaining, what this trend tracker is all about. But here's some things to think about. Obviously number one is just making sure that, is the trend still higher? Is it still in place? How strong is it? This is a very, very strong trend. You've got, the 200-day moving average here and the 50-day. 50 is well above the 200-day, which is a sign of a good uptrend. The price is obviously moving higher. You can see that, and it's above both of those moving averages. And so, keep an eye on these spreads, though. You can kind of see that, we've been kind of like this, and then all of a sudden we've made this pretty significant move just this year. I think we're up 4%-ish on the year in the S&P 500. But we are 5% above the 50-day moving average currently and 11% above the 200-day moving average. I mean, those are kind of getting up there in, kind of extreme range. I don't think we hit any of those levels throughout 2017, and you can see we were actually in a very nice uptrend. But as you bounce off of this 50-day, again, that's a sign of a nice uptrend that you want to stick with. We could pull back 5% from the current levels. Again, I'm not calling for a pullback, but this is just something to consider. This trend will still very much be intact if we get a 5% pullback and bounce off the 50-day moving average again. And quite frankly, until the S&P drops below the 200-day, from a price perspective, that's again something to consider, that we're still probably in a longer term uptrend. So you could sustain a 5 to 10% pullback and still very much be in an uptrend, and so that's just something to consider. I do think we have some great tailwinds behind us. The tax reform earnings season is here. It's been good so far. We've had some banks report. I think the things we've seen from a valuation perspective, which is where you would start really getting concerned about, seeing these spreads as high as they are if valuation was stretched. Right now, I think, pro forma for this, this huge tax break that all the corporations are getting and taking that into account, Analysts are saying, $155 of earnings for 2018. And if you look at the current price of the S&P 500 around 2,800, you're looking at about 18 times forward earnings, which, isn't, it's average, it's a little bit above average, but it's not something that's extremely stretched. And, I think until you get up towards that 20 times level, which would push the S&P up, over 3,000, I think that's when you would really start to start scratching your head about valuation a little bit. But we have some nice things, pushing that higher, some nice trends pushing that higher, which obviously is earnings, which is huge. You want to see that earnings growth, and we've been seeing that for the last few quarters. And the tax reform and the tax break is just going to, obviously exacerbate that trend, and that's a good thing. Other trends that are happening, and you can kind of see the underpinnings, and I'll show you some of these heat maps here. But you've got obviously we're in a rising rate environment. The Fed has been raising interest rates, and we're going to probably continue to see that the next couple years. But you've got the 10-year Treasuries up at 2.55. You've got the dividend yield on the S&P 500 down around 1.8. And so you can kind of see this spread has been widening. This spread's at 75 basis points, which is the widest it's been in a while. Obviously this the dividend yield here has been going down as the price has been going up. Which obviously those are inversely related. So you've been seeing that spread widening, and what that's done is it's caused some obviously rotation out of higher paying or higher yielding dividend stocks and into some more probably growth oriented stocks that maybe pay a little bit lower dividend yield. Obviously it's been bad for bonds as well, and so you can kind of see that. Again, this is the kind of value of just kind of looking at this stuff from a high level. You kind of understand what's been driving, some of these trends and underpinnings that you're seeing. These are all just gut checks. You can kind of understand what's happening with them, and so that helps you make that decision to say, what, I think it's about time to take a look at some of these sectors that are underperforming. And obviously, as value investors ourselves, we like to look at the beaten down sectors, as we're diversifying, across every sector. We want exposure to all of them, and the time to invest in certain sectors is when they're beaten down. But as long as you understand why they've been beaten down, that's kind of half the battle, and that's what kind of, looking at these trends certainly does for you. But just year to date, you can kind of see, staples, real estate, telecom, utilities, you can see that they're in kind of that red and orange range here in the heat map. Staples down, real estate down. Real estate's been the worst performing year to date. Telecom, barely up. Utilities down. So you've seen these sectors underperform, and a big reason why is this chart right here. And so we'll continue to track that. We are definitely starting to look at some real estate names, but just like on the macro level, you look at the S&P 500 and say, is that trend up? You want to look at the micro level within each sector too, and say, is this sector in an uptrend or a downtrend, and is it time to invest in it or not? Are valuations and momentum getting stretched in certain sectors, and is it time to maybe rotate out of some of those and into the ones that have been beaten down, and that's kind of what we'll focus on in our market trend tracker. So, again, you can see some of these ones in the red. That trend is probably likely continue in the short term. As we get a couple more interest rate hikes, we'll kind of see where the Fed decides to stop there, but it's definitely, I think, time to get a lot of these on your radar, though. Dipping your toe in the water. We never buy all of our positions, at once. And so, dipping your toe in the water, starting your position with maybe, a quarter of what you may have a full position at. That's the kind of stuff you want to do right now with some of these sectors that are beaten down, and obviously focusing on specific names that you feel are are down, and that's obviously for a different discussion. But this is where we get the ideas of where should we be focusing our attention as far as stocks go. One other obviously big trend that we've seen just recently is the price of oil, right? And you can kind of see how that's flown into the sectors. The price of oil, look at just 6 months here, up 38% over the last 6 months. And you can really see that starting to flow through the energy names and MLPs. You just look at, the best performing sectors over the last month and year to date are energy and MLPs. Look at MLPs up year to date, 9%, and energy up 7%. These have just been huge moves in these stocks, and these have been beaten down sectors. Quite frankly, just the last, call it 12 to 24 months. You can see actually they were the worst performing sectors, or one of the worst performing sectors, over the last 12 months. And so now we're getting a rotation back into those. And that's where I think we can continue to have some legs. And I'll show you some other charts here, on the next page, where we kind of look at each individual sector and say, where are we at from a trend perspective there? And is it time to invest in those sectors? But anyway, look, take your time, look at these. I've got a PDF of you can pull these up and print them out yourself as well, and just have them there as a reference tool for yourself. But looking at asset classes, kind of other than obviously real estate has been underperforming, and we just kind of talked about why. We got crude oil, bonds. Rising interest rates, tend to underperform, so that makes sense. We've got, the NASDAQ clearly was a huge outperformer in 2017. It's continued to do very well year to date. It's been one of the best performing year to date. So I think what we saw, and this kind of goes back to we had a pretty huge momentum year in 2017, and so the large cap growth and momentum names really outperformed the value names. The values names were beaten down, and the margin there was huge between the two. But what I think you've been seeing lately, call it the last month or so, those margins are starting to certainly narrow quite a bit, and just over the last week you've seen value outpace growth. And so I think that's a trend we're going to continue to see. So, as we're looking at some of the beaten down sectors and stocks within those sectors, I think you're going to see value probably start to at least keep pace or outperform potentially as this market goes higher. And the market can always go higher and things rotate. We're hitting all-time new highs, all throughout last year. And I think as late as, early November, like 38% of the S&P 500 was in bear market territory. And so there was definitely stocks that were leading the market, but it wasn't, one of those things where the rising tide was lifting all boats, because there was quite a few stocks that were, beaten down quite a bit. And, that's obviously where, some of this analysis kind of, helps us kind of pinpoint some of that. So that's just some of the higher level trends I'm seeing. We can obviously talk more about that next week and kind of what we're seeing. But I do want to show you the next page in the analysis, which is, again, just another quick kind of, I've got everything color coded here. So these are all the sectors from above. And obviously green is, sectors that are in solid uptrends, where the 50 days above the 200-day and the price is above both of those moving averages. So those are all in green. So you can see most of them are in green. And if we just kind of quickly, flip through, some of these, obviously consumer discretionary has been great. Retail, we've had a nice, the 50-day cross the 200-day, just in the last couple months. Just a very nice uptick there. So it's getting a little bit safer, obviously, to, we're not in this nasty downtrend anymore in retail. It's getting a little bit safer to invest there. Staples, we've been kind of flat, and you can kind of see the 50-day and 200-day moving averages have been kind of intertwined here, and we've had a little bit of a lull. keep your eye on that. I think this is probably driven more by interest rates and the fact that these are probably more value oriented names. So I think if we get an uptick in the earnings here with Staples, I think we see some we see some movement higher here. But watch those levels. Watch as this price maybe comes down towards those moving averages, and probably be a little bit cautious if that happens. Energy and MLPs, energy just in general, the kind of broader energy has been very good recently. Again, it was kind of like a retail. We had a nice cross of the 50-day and the 200-day. So we've gotten some stability there. MLPs, so this one's yellow. So the 50-day is still below the 200-day, which is why we're showing it yellow. But the price of the index has come up above the 200-day moving average, which is a bullish sign. So this is one where I think, even though we've had a nice run in MLPs just recently, you saw it was one of the best performing sectors year to date. I think there's still a lot of room to probably move here. Obviously, keep your eye on oil to make sure that trends continues to be up. But I think you're going to see, a lot of investors, kind of getting back into this sector, and we've bought a few MLPs ourselves, going back just a few months. So that one looks very interesting to me. Financials have been very solid uptrend since we've been raising interest rates. Obviously, that's a great environment for financials. Healthcare solid, industrials, materials. So these are all pretty safe sectors. Obviously look for pullbacks. Look for some of these sectors to come back. If we see industrials, for example, come back 5-10%. If we see some kind of rotation there, and we're gonna, if you see us bounce off the 50-day, that's where you want to time your entry points. As you're thinking about adding things in that sector. So that's why these sector charts are pretty important, to us, and I think focusing on them is a good idea. The two red boxes down here, so real estate and utilities, we kind of saw it in the heat map up top there that we had quite a few red boxes within these, but you can see why. I mean, these both of these are the prices are trading well below the averages, and that's obviously a bearish sign, and a sign that the trend's down. You're seeing real estate, the 50 days turning over the 200-day. Again, these aren't specific buy points, but it's stuff that just gives you insight into kind of what's the trend doing, and should I be cautious here. I'm liking real estate from a value perspective, but this is one I'm looking at very closely. I'd love to see an uptick here and get a little stability, before really backing up the truck there. But one big thing, the trend that this is following obviously is higher interest rates aren't the best environment for REITs. Same with utilities. Obviously, these higher yielding securities tend to not do or tend to underperform in rising rate environments, and so you're seeing the same thing with utilities here. But again, I'm seeing lots of good value there. So these are the areas I'm probably focused on the most, but they're also some of the charts that we need to be cautious. So pick the stocks, get your watch list together in some of these beaten down value sectors, but don't ignore the sectors that are moving higher. Look for pullbacks across the board in all these sectors that are in a much more healthy position, and then kind of pick and choose some stocks down here as you're building out your sector diversification. These are some good sectors to take a look at. So hopefully this is helpful for you. I think it's a great tool just to kind of as you manage your portfolio, and it gives you peace of mind. We may have a great year. I think we got a lot of tailwinds behind us, and just keep your eye on all these trends, and just make sure they're continuing to go in your favor, and where you can see some some places to focus your energy as far as value goes, and the rotation among these asset classes and among the sectors. That's a kind of a prudent thing to do. So hopefully you enjoyed it. If you like this video, obviously check out our website. We've got a bunch of, if you're a subscriber of our website, we've got a ton of great individual stock research there, and tools and things, and that's dividendinvestorsclub.com. And then if you like this video and you want to see future videos, please subscribe to our YouTube channel, and you'll get you'll get updates and all the videos that we do in the future. So have a great week, everyone. Take care.